Hello friends, welcome back for Bitcoin Technical Analysis. I'm your pal Rocky Outcrop. Let's take a look at the charts together. Thank you so much for joining me today. If you're new to this channel, then join the family, hit like, subscribe, all that jazz. You've seen YouTube before, you know the score, you know how it works. And I genuinely do appreciate likes and comments and all that, by the way, because it does massively help the channel. At least so far it looks like it does. So anyway, whatever, let's look at the charts. So what have I got behind me right now? Well, this is the CME chart, the Coronal Mass Ejection chart, the Chicago Mercantile Exchange. And why do we call it the Coronal Mass Ejection chart? Just for a laugh, right? Okay, well, if you've been subscribed for the last few months, you've heard me say this a billion times, so I'll try and be quick. But essentially, when there's a gap on the chart, the Chicago Mercantile Exchange chart, then sometimes it can create people, I like to just think of it as a coronal mass ejection because it can wreak havoc with people's sort of systems, really, essentially. And so that's what we have here, and let's take a look at it. So we've come in here on today's daily time frame on the excuse me, just close that out of the way. We've come in here on the, what I've done here is I've gone down to the 4-hour time frame on the CME chart just to begin with, because I wanted to start off by pointing out for all the fans out there of the 4-hour gaps on the CMEs that there's still this line here kind of showing where we haven't filled in a gap, just so that you know, Now, am I the biggest fan of 4-hour gaps on CME charts? Not really, but that's there, and they do tend to get filled, sure they do, but it's just kind of like the 24-hour ones are significant, whereas these are less so. However, it's there, so just kind of bear that in mind. I guess it depends on your own sort of position on it, you choose yourself, but that's still there. Anyway, go up to the 24-hour chart and see where we've come in at, and well, looking at this, you can see that there's this big gap here. And we've got that drawn out with this box, and where has the price come to so far? Well, it's come right up to the edge of the box and then slinked away again just slightly from there. Now, what did we say in previous videos? In all of the previous videos, really. In fact, ever since we had this on here, what have we said about this box? Well, it's to be paying attention to how the prices respond in and around this area when we get to it. You could imagine that just because it's a gap, and we've seen gaps being filled before in dramatic fashions, that it could just get filled right up, snap, done. You could, Another thing that you could imagine is that we'd get some sort of like 50% fillageness on the go here and come up and touch the 200 simple. You could. And then withdraw and think about like the rest of the gap, over time or whatever. Those are things to think about. Another thing that you could imagine is that we just come up simply to the gap and don't actually manage to fill it and get rejected from there. That's a potential too, in and around that price area. Now that we've sort of, in a sense, come back up to where we were before and put in, and you could be looking at things like whether or not we get some sort of double top type formation here. You could be looking at various different things. You could be looking at that stupid bump and run reversal pattern that we've talked about numerous times over the last ages. You could be looking at whether or not this actually turns into an island reversal, they call it, or essentially what would need for that to happen would be for us to open and close the prices over the weekend, and open back up with the gap up towards this top area here, leaving this gap kind of in place. Then you'd have this island bottom. You can check out Bilkowski's book for that. Nobody ever talks about them ever, and they don't really ever happen overall. You don't really see them on the CME charts, to be perfectly honest with you, but that could happen. That's something to look out for, and whatever. So let's just take a quick brief look at this from the perspective of that stupid bump and run reversal pattern. It's all logarithmic at the minute. I could change that if I wanted to. You'd have a bump here, coming down, touching it, retesting it, going off and up the way afterwards. What do you not have? You don't have an increase in volume, really, so to speak, quite yet. You could argue that you have an increase in volume, relative to there, but then your argument would be defeated fairly quickly compared to a bigger period of time. So there's that. Take it off log and sort of rejig it slightly so that it actually fits on here. again, and well, to be honest, it's more or less the same story. And who really cares? Nobody really cares about that, because it's just a stupid formation on the chart. I'm sorry, I shouldn't be so negative about it. It's just like, it's just one of the patterns from the book and if you were to use the book, right? Okay, in the opening sections of Bukowski's book, he says this is an encyclopedia. Why do I call it an encyclopedia? Because I myself use the book as an encyclopedia. If I see something on the charts, what I do is I go back into the book, I open it up, and I check it and reference it against it. This is the author of the book himself. So if you feel like that you somehow need to memorize it like a religious zealot and know every word, well, you don't, because the author of the book lets you off the hook of that in the first page of the book. Okay, but also bear in mind that you don't need, it doesn't need to be that pattern. It doesn't need to be that. It doesn't it doesn't, if it isn't a binary world where either it is that, or if it isn't, it's a failure of that pattern or something like that, where the pattern still exists, it's just been failed or whatever. You don't need to worry about that too much. And one of the simple ways of characterizing this bump and run idea is that you've just got this downward sloping trend line. It comes immediately following the broadening bottom section in the book, by the way, where you could be looking at broadening bottoms and asking yourself, have we got this descending broadening wedge on the go, and are we going to bust above it and have some sort of move off the back of that? It's not really a coincidence that it comes after that section in the book, and it's also not really that much of a coincidence that it doesn't really, who cares, right? Whatever, it's just like it doesn't really matter. Also, as well, I suppose these key things, like when it comes to pattern stuff, is that there's so much flexibility, really, if we're honest, when it comes to pattern analysis. You're like, yeah, normally this happens, and this is what you want to see. This is the ideal one, and this is the perfect one. Here's the perfect pattern. And then you have all these sorts of like variations on it. And of course, it goes up to a certain point where it varies. Maybe it morphs into a different pattern entirely. Maybe it just morphs right out of the structure that you're talking about. So you can always sort of make a case, and I'm not going to argue it. I've spent far too much time arguing about all that chat. So anyway, that's just that's there on the charts if you want to look at it. I don't think anybody that's realistic and professionally trading really particularly cares much about that. Anyway, what we're looking at the minute, just in terms of the CME charts, is three questions. One, does this get filled sort of immediately, and what happens thereafter? Two, does it get rejected from here and not get filled at all? And what happens thereafter? And three, will the prices come up into this area and find resistance in here on the CME charts, around where the 200 simple is? And that's kind of enough there for that. But I think that's kind of worth spending that time talking about during the episode at the start here, because we have a slightly different situation over on the spot prices, and it's a real thing. Anyway, let's get rid of this here, which would have fit on the way, by the way. This is one of these dynamics between log and not log. Anyway, we're talking about whether or not you could end up with some sort of stupid measured move. Sorry, I'm using the word stupid, and I'm being quite dismissive of things. In the book, by the way, as well, again, in Bukowski's book, if you're looking at that, minimum moves or measured moves are described as being like minimum measured moves. And if you've been watching along with the channel, you know that we don't talk about them like that. The word minimum. In fact, we kind of actually instead look at them as being the word maximum, really. But whatever. It really depends on your time frame and your mentality as you approach this. What have we got here? What have we got? Well, we've still got this sort of wedgy shape here on the logarithmic chart. We've still got a sort of, the debate, if you want to have it. Who cares? I'm bored of that debate now. And about whether or not it's a channel or a wedge. And what have we got? Well, we're still within the structure. We've got a couple of touches at the top side. We don't have a third one. We could touch it 5 times. This thing could go on for ages. Whatever else. If the prices did come up and touch the top of this wedge and go no further, if we want to call it that, actually, let's just take away the argument entirely. If the there you go, there we go, there it no longer matters, can be completely agnostic. If the prices come up and touch this upward sloping trend line here, which potentially could act as resistance, there's a couple of things happening at once. One of the things that's happening is, of course, that we're already beyond the 200 simple. That's great to see, and we're also beyond this area of resistance just here, potentially which would have been resistance, which has been or whatever, on the way up to here. This inflection point, let's call it. We're above the 618 Fibonacci retracement here of this zone, and we're above the 382, the bigger one. And what happens when if we get up to the top of this bar? Well, you know, we've gone past the 618 of the other Fibonacci. When I say the other Fibonacci, it's these two down here. They've got labels on them, body to body, wick to wick, whatever. And it's kind of, you know, there's two schools of thought on that. So I've just got both the schools of thought on this charts for us. We'd be coming up there, and we'd be looking at coming up towards that 8,000. You know, the mid 8,000s area. Brief revisiting of this chart is that you could see a touch off the 200 simple over here, and you know, you could find resistance at it, and that would tally with having come up to the top of this area here. So I suppose we can pencil that in as our next upward price target. Overall, what have we been talking about really in terms of this price action, just to get rid of all that crap, is that we've said that since the 13th of March we've had an overall upward daily trend on the daily time frame, characterized by higher highs and higher lows. And along the way, we've been saying as well, essentially, you know, that while the price is telling us that it's in an upward trend, that, you know, you just have to kind of remain sort of, it's an uptrend until it isn't, you know, your trend's a friend until blah, blah, blah. And so I suppose what we've been looking at is for sort of friend betrayal watch, you know. We've been keeping an eye on our friend who we don't trust fully, and asking whether or not they're going to betray us at some point. And you know, so our sort of our Shakespearean so that technically, I wouldn't actually think I've maybe pushed my madness too far by saying it's a Shakespearean type technical analysis. But, you know, anyway, whatever. We've been looking at this concept and saying, you know, while we're in this here, we're this overall upward trend, and we've got to respect that as it's the case, you know. But at the same time, we can look out for various things which might give us early warning signs if there's going to be a reversal. And of course, throughout it all, we've been taking profits. Now, what's happened in the most recent section is that it's been quite a while since we've had a higher low overall. And if you were to look at this as being a sort of local low or a higher low as well, you know, that was quite soon after this previous one. You know, not too soon. But you could consider this to be part of this overall upward movement, as this was a lower high and whatever during this particular circle here that I've drawn in. During that particular phase of the price action, you could have said that, okay? And so we still don't really have that higher low in quite yet. So we could get that any time, and we'd have to be aware when that happened if we get some sort of betrayal on the go from our friend the trend. You know, first sort of targets is supposed to be looking out for things turning around at all. Of course, are back down there below the 8,000 level where we have the 200 simple. You don't want to see that acting as support, the 233 exponential going up a time frame as well, just as it happens. You know, we have the same things happening here with the 50 simple coming in there, 144 moving average in there, whatever on the 2-day time frame, stuff like that. So, you know, there's sort of confluence across the time frames, as there would be, you know, with moving averages, as there would, you know, the maths and everything, it works out. But there you go. I mean, for instance, when you've got the 21 moving average, 21 periods or whatever, then you go up to the 2-day, then that would be the you know, the equivalent. It's just whatever, it doesn't really matter. It's the maths, you can work out the maths, it's simple. So right, whatever, back to the chart. So yeah, and what else kind of characterizes this in terms of like that Shakespearean type chats? I got to give up on that analogy. That we were talking about. Well, you know, there is this concept of perhaps, you know, that we've got a wedge type thing on the go here, you know, and how would a wedge look in terms of if you had, say, you wanted to do some sort of complicated maths about moving averages. Say what you did was that you looked at the previous 26 period exponential moving average, right? And then what you did was you got the 12 period exponential moving average, and you subtracted it from the 26 period moving average, right? And then let's say you just wanted to be crazy maths, supercomputer genius, geek nerd person, and you wanted to compare that to a moving average of itself, of that difference over the previous 9 periods, right? And how would that look in terms of the difference then between those, and if you were to chart that difference out on, say, a histogram, right? And if you don't know what I'm talking about there, that's the MACD. Okay, that's how that's calculated. That's how this histogram is developed. You know, this represents the difference between the sort of the signal line and the MACD line, which is the 26 minus the 12 moving average, whatever calculation, blah blah blah. And how would you expect something like that then to work during a sort of you know, if you saw a price action like this, or if you saw the MACD looking, like this, while you were aware, sort of generally speaking, that you were in an uptrend, what would you be thinking? Well, you think, well, if the difference is diminishing like this during the upward trend, then perhaps we have an overall upward rising wedge formation, and that's how these things all relate to each other. You could just be exclusively doing a pattern trading type living, where you look at this and you say, this is a wedge, has a statistical likelihood to break out towards the downside, blah, blah, blah. You could be looking at the price action alone and saying, look, it's divergent here, blah, blah, blah. And what does it all add up to? Well, it's just different language encapsulating the same concepts, It's really all it is, different paradigms looking at the same things there overall. And what have we got here? Well, we have that, right? We have that. So we have that where we have a rising wedge. If you want to call it that, let's call it that, right? And we have this divergence here and the go down here. Let's call it that. Let's call it like it is, right? Okay, so we have those things. That's interesting to see. What don't we have? What don't we have? What have we got? Which is like confirmation of this just going to continue towards the upside. Bearing in mind, of course, that higher lows and higher highs can come in. Actually, let's take it off logarithmic as we're talking about this, because you want to see this bar look similar, sort of. You want it to be comparable or whatever. And looking at this, you can see that as we've been rising up, these sort of individual rises are kind of less dramatic than they were at the start. Equally, the lows are kind of slightly less dramatic than they were at the start or whatever. And we have that shrinking down overall over time. Anyway, what we have is a higher high here on the RSI as it continues to go on up and into this what we call a bullish control zone. You want to see it coming up here. That's very good. If this was a bearish market, by the way, another thing to be aware of, generally speaking, with this, which we look at all the time, is this sort of, we call it the neutral line, but during our downward price action time or whatever, if the prices go down below here and come up to this neutral line again during the downward price action, you could consider this to be your oversold line, overbought line, as opposed to up here in the where I have it up at 80. Now, as well, a lot of people have it up at 70 instead of 80. There's various different ways of doing it. I never really point these things out to folk, really, the different nuances. I just say what I'm looking at, and that's enough, really, generally speaking. But you could have the line here at 70 instead of 80, for instance, in which case, if this comes up towards this area, you could start calling it oversold, whatever. There's all these various different ways of looking at these things. But anyhow, right now it's not bearishly divergent, okay? And the stochastics over here, likewise, not bearishly divergent. Now, RSI is kind of technically better during trends. It's technically better during oscillating price action. Whatever, who cares? And but if you want to call this a trend from this time frame perspective, then the RSI is still looking good. We're in that bullish control zone. What you want to see, we're above the moving average. We've not been we've not been rejected as yet from this area. Blah blah blah. What have we got down here? Well, the DMI, the ADX is at that 19 point something area. So we're right here saying, hey, we could get a strength of trend towards the upside. Blah blah blah. Now, if that were to happen at the same time as us breaking into this area up above 8,200s area or so, where we could be breaking back into this gap that we have on the CME chart, blah blah blah, then what you'd be looking at is this being a stronger upward trend, having broken significant areas of support and resistance in the past, having gone past pivot points in the market, going back into starting to say, like, maybe we're undoing this overall downward trend thing. You could start looking towards it. You would then, of course, be looking towards whether or not you can make higher highs, and ultimately you're looking towards 10,500. Let's not get too carried away, but that's what you'd be starting to talk about. The first sort of port of call, of course, is up in that 9,000s area, indeed, where the top of this box is, which we can no longer see. Oh, because I've hidden the drawings. The top of this box here is up in this area. If you were to get rejected from that, that'd be the 786 Fibonacci retracement point. It'd also be the 382 when this. That's just a relevant one now, so to speak. So let's just, I don't want that noise there anymore. Excuse me, sorry. So we'd be up here at the 786 area where the 200 simple is. Well, was. You'd be up here in this area, and you could potentially see a reversal at that point. You could potentially, bearing in mind where you'd be in terms of the overall price action. or else, you'd see things going on, and we could revisit all of this and ask the questions about how things are getting on yet again. We don't have divergence on the DMI. We do have it on the MACD, which is what you would see during a rising wedge, whatever. So there's different sort of things working for and against us at these points in time. Now, it's up to you. You're the one that makes the decision. You make the decision. Congratulations to you. Welcome to the channel. If you're new here, you don't know this already, I'm sorry. I'm going to dump you put the responsibility back on your shoulders. How awful. Well, I'm not a financial advisor, and none of this is financial advice. I'm just here to look at the markets with you without any FOMO, without any fear or greed, and just to kind of take a rational look at where we are and bear things in mind and put out a big picture for us to kind of, which will hopefully integrate into your own technical analysis smoothly without any conflict. This is why I kind of keep consistent with what I'm doing in terms of looking at divergences and general sort of patterns and sort of both sides of the coin every time as I'm doing it. Subscribe for more of that crap. But also, I wanted to put this in so it fits in amongst what you're also looking at. You might be looking at various different YouTubers or various different technical analysis. You might be reading ideas out there. You might be just actually, that's kind of the novice approach. You might be an expert yourself, in which case, you're just kind of looking out there to see what other people are talking about so you've not overlooked something or whatever. And I hope that all helps. But of course, it comes back down, the responsibility always falls on your own shoulders as to how you're going to end up trading any of this. And those are the kind of key areas that we're looking out for just now. Come down to the 4-hour time frame just so that we could kind of check in on how things have been getting on in this sort of overall 4-hour upward trend. Now, we did compare this high area over here to this one over here, in terms of looking at divergences. And you're looking at this here and looking at this here and saying, hey, that's kind of bearishly divergent, and likewise over here and here going, that's kind of bearishly divergent, and that sort of stuff. But at the same time, we said, hey, look, the MACD isn't bearishly divergent, at those particular points. And of course, again, conflicting signals. But on the 4-hour, what have we got right now is this latest high coming in here. Should this be a local high, then of course, as we can see, the RSI is now up here relative to over here. That would not be divergent. You've got the same sort of scenario occurring, kind of just starting to get in there close. It's not quite yet. There's no cigars, no pink champagne being handed out. It's still on ice. But at the same time, there we go. It's potential. It could go in and do that sort of thing. As we've seen, as we've discussed these things in advance, we always say it's stupid to say that the divergence is there when it's still potentially forming. You can talk about it forming, but you also have to look at the other side of the coin and say, hey, look, it could just keep going and not actually form and not actually show up, as we've seen recently on the 24-hour chart. Looking, by the way, as you can see where I drew those bits in there, you can see that we're not divergent between those things on the 24-hour chart either, and all the rest of it. So, you've got that sort of confirmation there. Is it all good? Is it all good? Yeah, we've got the upward trend. Yeah, it's a bullish trend, sure, in a sense. Are there negative things to be looking out for? Sure, there definitely are. We've got this diminishing volume across the board. We've got areas which could be pivot points and all the rest of it in the market. Now, why does those things kind of become important again? Well, because it could get to the point where you have the sort of the psychology emerge amongst the market, whereby things have done well and maybe they're going to do even better, and people will want to get in on that sort of last 20% of the move up towards 10,000 when you get to the 8,000 type area, thinking that we're going for 10,000, whatever else. And sure, the prices could even go up as far as that, then sort of crash back down again thereafter. It depends on how much people are looking for liquidity, if they are looking for that in the market, and if they want to create that liquidity themselves for going on. We also have fundamental shifts happening in the market at the minute. Within the next 2 weeks, we've got the halving happen, and now that, of course, is a fundamental difference in the market. And regardless of whether that's a fundamental bullish or fundamental bearish thing, it actually, the prices will not be determined necessarily by the core element of whether or not it's fundamentally bullish or bearish. That doesn't actually necessarily fully, sync with reality. Of course, it does in a very sort of superficial look at things, but reality is that, that perhaps, we could see supply go up overall and drops down. Now, we can look back at a quick sort of example towards that, and this is where I'll leave off on today's episode. By the way, thank you so much for sticking with me and for enjoying and the technical analysis and appreciating what we're trying to do here and taking part of the group and joining the Discord Discord and all the other stuff there, which is all really fantastic, and I really appreciate everything that you've done so far. Because, by the way, this what I do on a daily basis. I don't get paid for this or whatever. It's not whatever. I'm doing it really because I feel like I want to add what's missing to the market in terms of the overall kind of just fitting in there without FOMO or greed, without a bias on where the direction's going to go. Just here's some plain TA. Complement your own with this. Let's cut out let's try and mitigate some of that fear and greed or whatever, which is what leads to the primary reason which leads to people losing money in their accounts overall. And the only reason I do any of that really is because you guys watch it. If I was getting no views, I would just stop doing it. So this is all thanks to you. It's genuinely thanks to you. Every time one of you watches this, and if you think it's helpful and somebody comes along a month later and watches it, that's directly attributable to you. So I want to say thanks to you. Anyhow, let's just wrap up here by looking back here in 2016. I got it on logarithmic. I could have it. It doesn't really matter. The point that I'm making here is besides the point that there. In fact, let's just get rid of those things for now. And look in here now. Where do we have 2016 July the 9th? Or so. That was when the last halvening happened, okay? And we're up here July the 9th, yada yada. The halvening happens. What we've got, we're consolidating, prices going sideways, yada yada. So it's not quite the same situation as what we have right now. This is a sort of sideways consolidation that there was going on during this period here. As you can see, a fairly distinct triangle. And you could have had people saying at this time, these things can go either way. You would have people saying things like, there's a measured move off the back of this one here. We could get this jump up towards here, or whatever. Now, Bukowski, like I said earlier on, minimum measured move and all the rest of it. Well, minimum, or whatever is there. The move actually all the way down to there in the end. So that's when minimum makes sense. You would have had various different people saying various different things. Looking at the oscillators at the time here, on the run up to this here, it wasn't actually really too bullish, too bearishly divergent or anything. For you saying across MACD and everything else on the way up here, you'd be like, oh wow, that's so fantastic, and then run up to the halvening. Then there's a pullback in advance of the halvening, sure, whatever, of these conditions, and then we're here, but just measuring just purely from this point here, the end of the consolidation phase, not from the highs that we were at previous to it, not from over there previous to it. Maybe we should though. Nah, not from over there previously, just from this high, just from this drop down to where the prices went down thereafter. So there's a 30% drop there, just from this triangle down to here in the days following the halvening, and then the prices went up again. And I think that at times when there's all this chat on the go and you're looking at your own position and you're stacking up the sats, looking to try and really capitalize on some bullish price action, and you're doing that, and if you start accumulating tons in it, that 8,000 area, and then there's a 30% drop off in the price, then you could see your account liquidate, for instance. So you've got to bear these things in mind. They can happen in terms of fundamental changes in the market. Of course, the halvening is a sort of, technically you could say, a fundamentally good thing to happen in the market, because that line, if you're curious, was from volume, looking at volume in the past. It's a fundamentally sort of good thing in a sense to happen in the market, in that you're limiting the supply side of stuff and whatever. So suddenly there's less diamonds, so diamonds are more expensive, whatever. But as these things happen, you can see various different dynamics happen, and I just sort of throw that out there as a warning over the next couple of weeks. So there you have the bullish and the positive and the negative case. Of course, you could equally then go on and say that there'll be that we've had the lows here, we had this drop off, and that satisfies that downward price action that we saw then previously after the halvening had happened. You could make that case and argue it. I'm not going to actually, I'm not the arbitrator here or whatever. I'm not going to decide the outcome of those debates. I'm just putting up the proposition and the opposition cases, And yeah, this video's gone on for far longer than I wanted it to. Geez, I don't know if I said anything that's useful even. I'm not even going to summarize it. How awful. Let me know what you think in the comments down below. I really hope I've been helpful. I hope that you enjoy the episodes. I hope that you take part in the community. I hope you join the Discord. I hope you use the affiliate links to your own advantage that we've got organized here. I hope you do everything that's good for you and all the rest of it. And I hope that what's good for you is this Rocky Outcrop community, and therefore my gratitude extends towards you. And thanks so much for tuning in today. And I'll catch you in the next episode. Share this with a friend if you've got one that would think would like it. And if you're interested in more of this sort of junk, then you can watch the Ethereum, Chainlink, and Tezos videos, which will be a little bit more concise and briefing, because this was the one where all the chat is. In fact, Bitcoin's the one where all the chat is always going to be. So if you do watch any other ones, and come back for this one. Generally, this is the better one, in my opinion. Of course, I'm neutral. I'll catch you in the next episode. Thanks so much for tuning in. See ya.